Thank you for joining the Once Changing the World, which is India's first future tech meets sustainability podcast. And today I'm delighted and honored to have with me Mr. Joshua Scigala, who is one of the early movers in the blockchain Bitcoin industry. He built the Glass Books protocol to bring transparency in the crypto exchange industry and founded the first Bitcoin exchange, Vaultoro, to trade Bitcoin and physical gold with transparency. Currently, he's the founder of a DeFi project called the Standard.io, a decentralized lending platform run by a DAO that focuses on hard and soft assets as collateral. So Josh, really appreciate you taking time and being part of the podcast. You've been one of the early movers in the Bitcoin industry. So would love a backstory and what are you doing right now?
Thanks for having me, Eddie. And I'm just loving your podcast. They're so fascinating, such interesting people that you have. My backstory, well, it's I've been in the alternative economy space, I guess I would say, since around 2002 or 2000, something around that. And basically what happened was I built the world's first swap site where people could swap clothes instead of buying and selling. And that turned out to be a terrible way of doing any sort of trade, because there's always a time where two parties don't exactly align with what they want. And so having the ability to have some sort of token or credit in the middle where I can trade for your shirt, but you don't like anything I've got, so I can give you a token that can work in the rest of the marketplace. Hey, that's obviously the solution. Duh. Like, when you're young, you think, oh yeah, let's swap, And so I started looking around about 2004, 5, 6, around there. I can't remember exactly the date, but around then, about what solutions are out there. I didn't as the website owner, didn't want to create a central bank where I start issuing tokens, because then it just becomes the same problem that I'm trying to solve by having an alternative economy based around swapping and barter. And so I came across what the cypherpunks were doing. The cypherpunks were this mailing list that basically were discussing ways of creating a digital money with no based around cryptography, that didn't have a central authority. But even the central authority part wasn't really clear at that stage. It was mainly trying to have a monetary system that was based on cryptography. And the issue was that they couldn't solve that double spend problem. And the double spend problem is basically, if I send you a JPEG, Eddie, you don't know, do I still have that JPEG? And so that was an unsolvable problem. I thought it was unsolvable as well. I just sort of stopped looking after a while for the solution, and ended up just keep on going. And I worked in television, special effects director, and stuff like that. And then eventually, Satoshi's paper came to my table around 2010, because I kept on keeping an eye out for what was going on in that space. And lo and behold, Satoshi had solved that issue of the double spend problem. And it's been a rabbit hole ever since. And on the way, of course, there's been many hacks. We've just had the FTX hack, but back in the day, the very first Bitcoin exchange was called MtGox, MtGox. And it's funny because MT stood for Magic the Gathering Online Exchange, which is a card game. And that was basically an exchange to trade these cards. The founder found Bitcoin quite early, like me, and converted it over to a Bitcoin exchange. And that ended up going broke because someone hacked it. But the reason why the founder didn't realize, got in such deep trouble, was because there was no transparency in that exchange. Even the founder or the CEO, Mark Karpelès at the time, he couldn't see through. And I like to give people the benefit of the doubt. I try not to see malice in people. It was a good running business. I don't think he would have wanted it to get hacked and shut down and everything. But I think if he had a good transparency protocol where the whole world can see in, someone would have put red flags up before it got hacked, before it got destroyed. And so I went on to then build a transparency protocol for exchanges, as you mentioned in the beginning, called the Glassbooks protocol. And this is a very easy way of people being able to audit an exchange, a Bitcoin exchange. But yeah, so after the MtGox collapse, I lost a lot of money in that, and I went on to create a Bitcoin exchange that traded between Bitcoin and physical gold, because we all got into Bitcoin to get away from fiat, to get away from government issued money. Yet we were trading all Bitcoin with US dollars or rupees or Australian dollars, all the fiat, of the world. And I really wanted to figure out, hey, can we just start trading into gold instead? Because gold can be fully allocated to you as a person. It can be fully insured, unlike a bank account. Bank accounts aren't insured to very much. And it can be fully audited. So banks just generally aren't audited because they're in what's called fractional reserve banking. And we can go into that later. But I tend to go to these deep roads far ahead of myself. But that's a little bit about my history.
Lovely. You said you began with the idea of swapping, butter. What do you think could be the future of the monetary systems? Because today I think the world is completely changing. I'm saying the far out future. Because with artificial intelligence coming in, we have something called as stable diffusion. What that's done, we always thought that art and creativity would be the last frontier. Because AI wouldn't be able to breach that. But here is Dolly 2 and stable diffusion. Through maybe just you type in text and voila, you get an image. You get. There are people who are also working on text to 3D image or maybe music, and these artificial generally intelligent agents, softwares, algorithms are now becoming, from the narrow approach of being able to do specific things, they can do a wider things, more like what we humans can do. But it's still we far away from artificially general intelligent. But even with this narrow intelligence, we have been able to automate quite a lot of things. So automation is staring upon us. So the reason I spoke about stable diffusion is because what happens to the creative industry. Those people would be jobless, and then obviously the monotonous jobs, which is desk jobs, which can be easily automated. In the near future, when things are really automated, obviously humans will not, there won't be any jobs for there. Humans will lose meaning, and in that world, though I've gotten a little far out, what do you think could be the future of monetary system? Though I've gone a little way too far out, but maybe thoughts on that, because you mentioned barter and swapping.
I don't think you have gone too far out. I think it's a very big problem that needs thinkers to think about. And I've talked with economists for a long time about this. And you're right. The answer has always been, don't worry, people will just have more time to do creative endeavors. And then AI comes along and takes that first, really. These text-to-image generators are phenomenal. And anyone that's had a play with them gets their, falls back on their chair, because it's so extraordinary. It's so creative. It's so beautiful. And then when it comes to also teachers, doctors, I would far prefer a well-trained doctor AI than a human a lot of the time. There's a huge, massive landslide coming towards humanity, where people will just stop using the services of humans because it's far quicker and cheaper to use an alien mind. I don't mean alien from another planet. I mean an alien that's been born here, that can do so much. And when I look at the basics of economics, which is supply and demand, the supply-demand ratio, you start to think about how can we solve problems for humanity when humanity's main source of eating and survival has been by putting work into something and holding that value in a currency and then being able to spend that in a marketplace. The problem is when I can't work for something anymore, and I'm sorry to sound so basic, and it sounds so basic as I'm saying it, but it does break something very, very fundamental. And a lot of economists, especially in the free market sense, will say there's always enough work. There will always be work. But I tend to doubt that, because it's just that when robotics can start to do, robotics are very right now, but as soon as they get very agile, as soon as fingers can touch feathers and feel them and juggle and one-handed do Rubik's cubes, and this is already possible. You add an artificial intelligence on top of that, a general AI, and we've got a real issue. And I hope that we don't devolve into some sort of Luddite culture where we start destroying machines out of spite and anger. I hope that we can be in a post-enlightened society where we can figure out a better mechanism. Now, there's a lot of push for a sort of a government-sponsored minimal wage that is given to everybody. The problem with that theory is that governments don't earn any money. There's no earning from a government. They create money out of thin air, and then they inflate the currency system. So, and what's beautiful about cryptocurrency is that we can see these experiments playing out. We can see these experiments playing out where an organization starts a new cryptocurrency and might like distribute airdrop, so to speak, and then they're out of those coins. Now, what they could do is they could write a smart contract to have an infinite supply, but then what happens? Well, you get hyperinflation, so that token doesn't have value anymore. One of the answers I've thought about a lot is having a universal basic income, but that's based on a blockchain, because if you give a universal basic income to a government, the government has then full control over its citizenry, because if they don't like something that someone's doing, they just cut you off. If they, and this is really important. We've gone through generations and generations and generations to get to the freedoms that humans have at this stage in free countries, and it can easily slip away into a dystopia. So it's very important to think these, and this is what the importance of philosophy really is at this stage in history, is that we've allowed philosophy to go off into the doldrums of, are we living in a world within a world, or just stuff that doesn't really matter, when really we need thinkers to think about the problems of the world in terms of securing freedom for humanity, allowing monetary trade between humans so that we can still eat and survive and be prosperous and happy. That's the main goal. And this is the balance, right? Tyranny versus freedom.
You mentioned about governments printing money out of thin air. You also spoke about the centralized ways that they function, and possibly UBI, which sits on a blockchain, could be the future. If you had to maybe briefly talk about money, fiat currency, and maybe the wrongs of it, what would you have to say? And what do you think? I mean, is cryptocurrency the answer? What is the answer for the future of the monetary system?
Many people talk about this concept of Bitcoin maximalism. Or Ethereum maximalism, where one currency wins out. And I don't mind if there's a crazy central bank issued digital currency that controls every aspect of your life. And if you have a view that's against the current regime, then they will cut you off or stop payments coming to you. Or I don't even mind. Of course, I mind that. But what I would like to see is that there's competing currency systems, because competition is what allows for corruption to be subsided. So that if you find, and when I say corruption, I don't mean like there's some person that's being corrupt. I mean a fundamental perversion of money, where if you have one system that is going rogue, you want the ability to have exit doors, and just that ability to have an exit door to use another system keeps a check and balance on that system, because they want control. They want to keep people in that system. If they can escape, then it stops. So it's I think that's the fundamental need that humanity needs to head towards, is that no matter what comes in, we need to have the ability to allow us to choose different monetary systems. So when it comes to blockchains and cryptocurrency, it's got a lot of growing pains. Bitcoin is amazing, especially the modern technology. We were the first to implement the Lightning Network on Vaultoro when we upgraded to what was called segregated witness, and this was after a long battle with the scaling of Bitcoin. How do we scale to mass people, because it gets very expensive, and so now that we have the Lightning Network, we do allow for massive scaling. It is amazing. It's a beautiful technology now. It's almost ready. The user experience still needs some work and stuff, but it's almost ready. The problem is that the volatility is still way too big for the normal person to cope with. And while there are techniques like hedging and stuff, which again, they're too complex for people. They don't want to think about shorting something because they're long something. They don't want to think about these sorts of things. They just want to get paid, and then they know they've got a unit of something, and they know that there's how much milk costs, and the milk is staying pretty close to that cost, so they can think into the future. They can start to save. And this is what Bitcoin doesn't really allow. So this is why I'm focused on building an ultimate stablecoin protocol with a great team of engineers to think about everything that's good about cryptocurrency that we love, but to have a stable version of that. And again, it should be competing. It shouldn't be the one. It should be competing.
Can you first, possibly explain what stablecoin is, and maybe even CBDC, and then maybe you can talk about the standard IO, what you're building.
So stablecoins came from the idea. Well, the first stablecoin was a very, very simple idea, but it was very juxtaposed to the idea of Bitcoin, because what it was a token, a digital token, a cryptocurrency, and one token represented $1 that someone put into a bank. So this happened because out of necessity. The early Bitcoin exchanges found it very, very difficult to get bank accounts, and banks, when they got one, the bank would shut it down a week later, and so they were I had teams opening up bank accounts. Because the world didn't know about it yet, and the media just loved clickbait. So they saw Silk Road and drug marketplaces and dark web, and all of this is very fantastic clickbait, right? So most of the narrative behind Bitcoin wasn't about, wow, self-sovereign hard money that is a bearer-based asset. No one controls it. All of these virtues were set aside to these really awful virtues. So the exchanges found it very, very difficult to get bank accounts. Now that that's changed a little bit, it's a little bit different. But back in the early days, that was the case. So Bitfinex, along with some other people, started what was called Tether. And Tether was basically that. They would generate one token for $1 sitting in a bank account. And then they would always say, you can always bring this back to us and we'll pay you that dollar. Now, if anyone knows any monetary history, we know the similar thing happened with money. This is how fiat money started. This is how paper money started. We would have people carrying around gold. Generally, they were meant for the nobles, but the common people would have silver, and they would carry these silver coins around, and they're very heavy. Silver is very heavy. So instead of carrying around with it, you would bring it to a vaulting facility, and then you would get a receipt from the vaulting facility for how much silver you've got. And rather than going to the vaulting facility, picking up your silver with the receipt and going to the market, you would just go to the market with the receipt and this paper receipt and start using that as money, or currency, I should say. So what then would happen? Obviously, the vaulting facilities just started thinking, let's just write more receipts. If you've got a receipt, let's just write more. So they start giving these receipts out to everybody, and they made so much money because they could write these receipts on a loan and ask for interest back for those loans. And they didn't need any silver. They just literally wrote a receipt. So there was the printing of money and this became the fractional reserve banking. There's a fraction on reserve of how much liabilities are out there. And if you now fast forward to the Tether days, they can do the exact same thing. They can say, well, you leave your thing here. Here's a receipt, this Tether token, and you can come back, claim it anytime. Now, they're speculating with these funds. We don't know how liquid the banks are. We can have another 2008 financial crisis. A government can not like it and shut it down, or confiscate everything. The central bank can do the same. There's a whole lot of things going. Or just generally thinking, hey, Tether people are speculating with the underlying asset, and now the crypto community is speculating with it over here. This is a recipe for disaster because it's just all funny money. And so that's the first type of stablecoin. And obviously this is something that shouldn't be allowed because it's totally opposite to what Bitcoin was all about. Bitcoin was all about provable 21 million. No one controls it. There's no single party that can be corrupted, and all of these wonderful things. So the second type of stablecoin a lot of people would have heard about are algorithmic stablecoins. And the latest one being was called Terra Luna. And Terra Luna ran under the idea, and by the way, this wasn't the first algorithmic stablecoin. There was many before, and they all collapsed. But for some reason, Terra Luna thought they could do it again and not collapse. So what is Terra Luna? How did that stablecoin work? They would issue $1 worth of a stable cryptocurrency, and they would say, this is stable because it's backed by our governance token. So what they would do is say, let's say the governance token is worth 50 cents each. They would say, oh, we need 2 governance tokens locked up in a smart contract that would peg the $1. So now, because we've got 2 governance tokens worth 50 cents each, they're worth $1, right? So now we've got $1 backed by $1. And you're like, okay, makes sense. Now, if the governance token drops in value to say 10 cents, they would just print 10 of them and back 10 of them because they're worth 10 cents each. We got 10 of them. It still equals $1. And so this $1 stablecoin is all good. You're good. Now, this kind of works in a what's called a bull market where markets are just going up. I don't think it even works there. It just has the guise of working there. But in the downward market, they just needed to print more and more of the underlying governance token, this token that would back these dollars, that they ended up printing literally trillions upon trillions of them. And of course it just went to zero because it became like a hyperinflation. And so this is the idea of algorithmic stablecoins, and the big allure of algorithmic stablecoins was the idea of capital efficiency. And I'll explain what that means. with the third type of stablecoin, which is the standard, and what MakerDAO is as well, and there's a few others. And what it really is that users send actual Bitcoin or Ethereum into a smart contract. And when they lock up, like, let's say $1,000 worth of Ethereum into the smart contract, they can lock that. Just think of it like a safe. You have a safe, you put in €1,000 worth of Ethereum, you lock it, and then you can generate a stable cryptocurrency up to about 50% of that value, because this thing's swinging like crazy, right? So you don't want to do up to it. The whole point is to have more locked up than stable coins printed. And then you basically have a loan to yourself, which is also an interesting concept. I can borrow money from myself by locking into a smart contract, almost like a pawnbroker, where you go to a shop with a bike, let's say, and you need some money, you need some liquidity. You've got your bike, you don't use it very often. Hey, can I borrow money till next week? Here's my bike for deposit. I'll borrow some money. If I don't come back, you can sell my bike. And so this is the same idea, except without a pawnbroker, without that central authority. You just have a smart contract. So what this means is that you have a provable amount of actual value that cannot be printed out of thin air because it's a finite number, locked up into a decentralized grid of smart contracts where individuals mint stable cryptocurrency from themselves, from that value, and they can't get access to that value until they buy back those stable coins that they borrowed or minted, and send it back to the smart contract. Once it's all zeroed out, they can then unlock that vault and take out the collateral, which is worth more than what they issued. Sorry for the deep dive there, folks. But
thank you for explaining, Joshua. Would you like to elaborate this a little bit more? What you guys are building at Standard.io and the token, and you a little bit more, please.
Yeah, sure. So the trouble with the last concept that I talked about was that it has an interest rate on it. So when I lock up in the traditional method of the over-collateralized stablecoin, which is the last mechanism where you send value into a smart contract that you hold the key to, by the way, this is a really key feature. Nobody else can get access. And we've seen things where a central party like BlockFi, which was a company where you could send Bitcoin to, and they would lend you money for that, rather than trusting them, because they went off and speculated with users' funds and collapsed. Rather than that, what you do is you lock up into a smart contract, and nobody else has access to that. Only you. It's the contract base. The program says you have the private key. All you need to do is pay back what you borrowed from yourself. Now, how the traditional over-collateralized stablecoin works is that you lock up those funds, you mint a stablecoin. Now, that when you've borrowed that, you've minted the stablecoin. Now that has a little bit of interest to it. Let's say it's 1%. Now, if the stablecoin drops below $1, let's say, what they would do is they'd lift interest rates across the entire network of people that have borrowed from themselves. And some people would say, like, "Ooh, that's a little bit too expensive now. Now it's 3% interest. So I'm going to buy back stable coins from the market. I've bought my car and stuff. I've spent my money that I borrowed from myself. So I need to buy back those and pay off my debt." That buying pressure that I'm doing lifts, because a lot of people are doing this now, because 3% is too much. I borrowed at 1%, 3% is too much. So that buying pressure allows for the stablecoin to rise, because more buying, more demand equals a higher price, right? And so this is how that I don't like the thought of base money. If we were to create a brand new money out of thin air, that would allow for a fair system, I don't want interest involved in that. Now, I've said it on another podcast, but I don't see a problem. There's a lot of religions that find usury a problem, and I can understand why. But I actually don't find, if I was to lend you money, Eddie, I don't find that there's a problem there, because I've saved the money, I've worked for it, and I've got now an opportunity cost, as they say. So I'm not able to do things. I'm not able to employ people or do other things with that money. Whereas you can now. And so for that ability, I'm going to charge a little bit of interest. But if we charge interest on the base layer of money, where central banks are printing it out of nowhere and asking interest for it, there I see a corruption. I see a perversion in logic. And so what the standard wanted to do, what we wanted to do at the standard is really figure out, how do we have this over collateralized stablecoin protocol with 0% interest at a fixed 0%. And how we do that is to first issue the stablecoin using a method where people would send in Ethereum into a global smart contract, into a smart contract that everyone can access. And as Ethereum goes in, what they get back is the first stablecoin at 80 cents. So we're doing the euro. So we'll stick with euro. The first stablecoin is euro. Then we'll be doing Indian rupee, US dollar, Australian dollar, British pound. We'll be doing all of them. But the first one is a test case for euro. So what will happen is people will send Ethereum into a pool, and as more and more, and in return for that, let's say they send in 100 Ethereum, they will get 120 euro. 100 euros worth of Ethereum, they get 120. So they get euro at a discount of 20%. So what does that do? Why is that? Because we need a pool of liquidity that always buys back. Why is a stablecoin stable? Because you can always, it's pegged to something, right? It's pegged to the euro in this case. And so how does something peg? Well, I can always take my euro and buy euro worth of anything else. And how does that happen? Well, we need one large pool of liquidity that will always, you can send your euro into that, and you'll always get €1 back of Ethereum or wrapped Bitcoin or something like that.
So Joshua, I completely understand this. I mean, I don't understand it completely, because I think, Web3 blockchain, it gets very complicated very, very fast. If you had to kind of like maybe summarize it briefly and simplify it, what standard IO is, and you're saying that the token is a stable coin, it's pegged to the euro. What are its utility layer? What would you have to say briefly?
What we're doing is building, first of all, a pool of cryptocurrency that anybody can get access to. By if they have one euro, they can get one euro out of USD. So that's phase one. And how that's built is by giving people access to euro. The first people that buy euro buy it under €1. So they buy it at a discount. And as more and more liquidity comes into that pool, that discount becomes less and less until we reach a 1-to-1 peg. And at that stage, it's considered a stable coin, because now there's a whole pool of money, and anyone that can take that euro and send it back to the pool and get €1 out. Now, anyone with half a brain will realize there's less value in there because it was sold at a discount than there is euros. So there's the second stage, then the second phase to this process. Now that people have euros that they've just bought, what they can do is they can take that euro along with some Tether or some DAI or some other stablecoin, and they can add it to a liquidity pool inside Uniswap. And Uniswap is an exchange, is a decentralized exchange. And for doing that, we pay them a yield. We pay them, the protocol pays them the governance token. So it's a great way of getting cheap governance. So first you buy euro at a discount, and then you take that euro and you take some another stablecoin and you put it into a Uniswap liquidity pool. Now that we've got that, what that means now is we've got enough liquidity to stay stable. After that, we release these smart vaults. These smart vaults are the ability to grow the economy out. And so when we do that, people will be able to lock up assets individual by themselves, like I mentioned before, into these smart contracts, and be able to issue themselves brand new S-Euro. Now, if they ever want to sell that S-Euro, they can either send it to the liquidity pool, that stability pool that we started building, or they can do it on a secondary market or something else. But the whole point of stablecoin is to have enough liquidity that will always equal 1-to-1 peg. And this is it's a very complex thing, but this is the whole. I think it's worthwhile for people to understand what liquidity mining is, or what yield farming is inside the decentralized finance space, because decentralized finance is taking a lot of the financial primitives we see in the legacy system and cutting out all middlemen. And while some will say this goes to the first problem that we talked about, Eddie, about loss of jobs and such, I think there's a general flow towards efficiency. And for instance, if you were to put money into a bank and earn interest from that money, why is there so little interest on that money? Is because the bank gives it to about 3 or 4 third parties before that gets put into, like, given to a market maker, let's say, and the market maker will try to speculate with those funds. And then when they make some money, they'll pay every middleman on the way up until it gets back to your bank account. DeFi allows you to directly put money into automated market makers directly. And so that's why the yield's a lot bigger. And that's why I feel that most liquidity will head into DeFi later on. Yeah.
And this sits on a DAO, right? Would you like to talk a little bit more about that?
Yeah. So the DAO is, for me, a DAO is just as interesting as Bitcoin itself as a concept. A DAO, for those that don't know, is a decentralized autonomous organization. And what that means is that we have these cryptographic tokens, right? Now, Bitcoin started it, but Ethereum allows anybody to create one. And what we can do now is we can create an organization and say everybody that partakes in doing things within the organization gets paid out in its native token. And there's usually ways that native token can generate some value. But what happens then is all these people that are invested in the success of the business, of this protocol, of the thing that's happening, or whatever the DAO supports, support the growth of that. So in the legacy world, we can say that something like Adidas or Nike have been the only ones that have managed to get its users base invested in the success in a way. So every user that loves Nike wears the logo right there on their shirt. Whereas the DAOs, what they do is they say, okay, well, if you do something within the DAO, you actually get paid some of these tokens. So now we have all the users, millions of people wanting this protocol to be successful. And so I think the DAO concept will basically take over the traditional concept, because you have almost like a mixture of the ideas of free market capitalism with some of the ideas of socialist systems where you have cooperatives and such, where everybody is part owner of the thing that's happening. And so that's what I find really fascinating with DAO. So the standard is a DAO where millions of people around the world will be participating in the success of a stablecoin for an over-collateralized stablecoin for every country. So to go back, just one last thing I would like to say about the standard is really the idea of the standard comes from the gold standard. It's the idea that the government had a bunch of gold and they would issue paper currency against that. Well, we don't need a government anymore to do this. We can allow people to individually lock up assets and mint a currency from that. And we're starting out with Ethereum and Bitcoin, but we will be very quickly moving also to tokenized gold. So people can basically put tokenized gold into their smart contracts, and there's all sorts of things like that.
Yeah, so exciting things are happening. I think in the next possibly a few decades. I mean, the way we do business itself will change. The community will get to play a larger role in playing, charting out the future of an organization by contributing. Would you like to share your views on the FTX collapse? And while you are at it, maybe also talk about this tweet. Dr. Saifedean Amos, he had tweeted that his tweet. I'm going to read it out for you. It says, "Take your Bitcoin out of exchanges, because Bitcoin exchanges are run by people who learned fiat finance. Gambling with depositors' money is normal and healthy for them, because in the fiat system, in the central bank destroys the currency to bail them out every time it goes wrong." So what are your views on that? In fact, a few weeks back, I was having a conversation with Vijay Krishnan, who happens to be the CTO of Consensus, and he was also mentioning that we have the same people who run the banking system or the fiat finances who are onto the Web3. How do we, I mean, is there a way to actually, bring about or changing this monetary system, or we'll always have the same people running the new world with maybe just a narrative?
There's the idea that if we were to take all money in the world, every bit of money, and put it in a massive pile, and then distribute it absolutely evenly across everybody, that within 6 months, the same wealthy people would have that money again, and the same poor would be poor again. Because some people are just better at understanding money, better at running with it, better at doing stuff with it. And so it's a very human trait that there is a bunch of people that are very good at it, a bunch of people that are terrible at it, and a whole bunch of people in between that sometimes get lucky. This is why I'm such a proponent of building transparency and rule sets in cryptography rather than humans, because these exchanges, and the gentleman's right, they will always head towards maximizing profit. And the easiest way to maximize profit is obviously not the small amounts of trading fees, because anything to do with money, any fintech product has very, very small margins, because no one wants to spend money to send money. I don't want to spend 10% on sending my couple of bucks over to you, right? I want to send a couple of bucks to you and you get a couple of bucks. And so all of these fintech companies that deal with stuff deal with tiny little margins. So what's more obvious is, well, there's a whole bunch of deposits here, and we're going to use that to leverage. And there is issues with proof of reserves. So we can say, the blockchain's fantastic for transparency. We can say, show us your cold wallets so we can see every amount of crypto that you have, and show us how many people have deposited. So you can see how many people owe stuff to an exchange and how much is in the cold wallets. And you can sort of equal them up and go, okay, well, they look pretty liquid. The problem is that we don't understand their liabilities. We don't know how many, if they've gone and made written contracts as a leverage on that. So they've borrowed against that amount. Now, this is why I really love decentralized finance, because we can make the liabilities as well as the obligation. Like, you can basically make everything transparent within DeFi. Everything is visible to everybody. The issue with decentralized finance is that there is code, and if the code is written badly, you can have a hack. So if there's a large smart contract holding a lot of wealth, and and someone can figure out that there's a bad bit of code in there and drain that thing, then that's a problem. But you can remove the idea of a centralized manager being either corrupt or inept, or both. So by disabling that, it's one step closer to having a better monetary system, and we can do all of the wonderful stuff, as I mentioned before, with interest bearing instruments and such in decentralized finance at a much higher efficiency scale, so that the yields are far better than they are in the legacy system because there are just less middlemen. So yeah, I think with the FTX disaster, like anything in the cryptocurrency space, there is this idea of anti-fragilism. So if something is attacked or false, or badly thought out, the next version will be better because people learn. And I've already seen after this FTX thing now, CoinMarketCap, after years of Vaultoro being the most transparent exchange in the world, after years now, after FTX, they actually have a little section where they can show their liability, their glass books. So they can show on CoinMarketCap, Binance can show how much is in their cold wallets and what's on store. But again, it doesn't cover liabilities that are contractually written.
Right. The exciting thing, what's happening right now is that, like you mentioned, after these collapses, there are entrepreneurs who are looking at it with a fresh lens and trying to correct the wrong. So I guess, and we asking braver questions. So maybe possibly in the next few years, maybe we'll have an exchange which is really transparent. And what are your views on this, the fiat currency? Do you think that in the near future it will give way and maybe to cryptocurrency becoming the mainstream exchange platform?
CBDCs are coming. Indian government's talking about it. Peru's talking about it. Australia's talking about it. UK's talking about it. America's talking not about that, but an instant settlement system, which is pretty much the same thing. And there are grave dangers coming from a philosophical freedom standpoint to these, because right now, if two people send money to each other in the UK, there's about 300 plus banks, and let's say Bank A, I send money from my bank A to Bank B, and it doesn't happen instantly, right? There's just an IOU set up, and at the end of the day, all those IOUs go to the central bank, and that central bank will then take all the IOUs from the banks and settle them. So if Bank A altogether has, let's say, 1 million that is being sent over to Bank B, but Bank B owes 500,000 to Bank A, then Bank A will only have to send 500,000, because why send 1 million and then 500 that way? Like, let's just send half of that and then it's all settled, right? So this is what the central bank does. But the central bank doesn't have any idea of all the transactions that made up that 1 million or that made up the 500K on the Bank B side. They don't understand. They don't know all that. That's all hidden from them. And so the bank has a contractual agreement with the user to keep privacy for the user. Of course, government can reach in, but they need subpoenas, they need court orders, they need processes to do this. If you have a central bank doing basically cutting out all those banks, everybody's got an account at the central bank, and every transaction is checked of what it is, who you are, where it is, and what it is, then you start to have major control issues. Because, for instance, if there's another lockdown, for instance, because that's now a thing, you could basically say, well, you're not allowed to spend your program or your new currency outside of a kilometer radius of your house. Now we need to stop global warming. So you can only buy up to 15 liters with your currency of gas every month. Or hey, there's an obesity epidemic. You're only allowed to buy 3 bits of candy a day. These are, yes, people will say, well, that's crazy. That's going far too far. But these are the sorts of controls that can happen. And we can look into history at something like East German Stasi, where the state was paying thousands and thousands of people to spy on each other. So you never knew who was reporting you to anyone. So but this mechanism, you don't even need that because money tells everything. So cash is actually extremely anonymous. It's the most anonymous money you can get. And it's a very important part of the economy because once you stop that, you can start to get, well, similar to the social credit system in China. And governments with large populations love these sorts of control mechanisms because it allows, it allows for massive control, especially through narrative control, because you just shut down certain things. And the last 2 years have been of the pandemic have really allowed governments to test how people will comply under a guise of fear. I'm not saying that, it sounds very conspiratorial, but from a freedom perspective, it's always important to step back for a moment and consider the powers that we're giving up for the conveniences that we're getting. So what that will happen with these CBDCs, will say, it's so convenient because now when you actually pay someone, they get it in their bank account straight away. They don't need to wait 24 hours because the settlement happens right away. And people go, wow, that's great. Oh, fantastic. But actually, we can already do that in cryptocurrency. We already have that ability. And so when you talk about the competition between government currencies and cryptos, I think it's very, very important that people understand the blood that has been spilt to afford us the freedoms that we have now in every country. And for us to give it all up for convenience in something that we've already got that convenience somewhere else is a grave mistake. And we should heed the warnings from crazies like early Bitcoiners like myself that tend to see patterns and try to just take a step back and ask, hey, we should discuss this. This shouldn't just be a default that gets implemented.
Joshua, really appreciate you sharing your insights on CBDC and how it could really go completely wrong. And yes, I think the centralized, the governments, the banking industry are trying to leverage the crypto, the blockchain industry, and they're also trying to kind of take out the features of blockchain so that they can build something which is still remains centralized in some ways. Now, obviously, because of the FTX, there's global, everybody is going bonkers and saying there should be regulatory frameworks built in for cryptocurrency. Do you think that this would possibly kill the decentralization and maybe push us towards the regulation would push us towards possibly creating things which are like CBDCs and more centralized? What are your views on that?
Absolutely, they will. And it's interesting that when a centralized authority when MtGox collapsed, the headlines were the CEO of Bitcoin hacks Bitcoin. That was the headline because they didn't understand that Bitcoin was a decentralized system and MtGox was a centralized system that was basically just taking it. And that was the CEO of that thing. It was like saying, the US dollar has been hacked when really there was a bank robber, right? So these sorts of conversations were happening back then. Now, with the FTX collapse, the same misunderstanding is happening. They're saying the FTX is a huge calamity. We have to regulate cryptocurrency. And you're like, hang on a minute. No, you've got to regulate exchanges. And by the way, exchanges are already very, very regulated because there are laws. You cannot do what Sam Bankman-Fried did without going to jail. He was doing a lot of illegal stuff. So you cannot get more illegal than illegal. Like the laws were already there. They just weren't looked out for. But these what the narrative is saying is that we need to regulate decentralized mechanisms, which is kind of impossible because it doesn't matter, as the old saying goes, it doesn't matter how many guns you point at 2 + 2, it's always going to equal 4. You cannot make it equal 5 through force, because code is ultimate law, natural law. So when we look at cryptocurrency, and especially decentralized finance, there are regulations in decentralized finance. It's only that those regulations are coded in, those laws are coded in. Yes, not everybody can read code, but the few that can warn people of bad code. And this is why we have code auditors that will audit code, give warnings to maybe there's a certain function in there that allows for an upgrade secretly or something like that, which would then inject some bad code or something. But these are things that auditors can find. Now, in terms of the FTX thing, I maybe there does need to be more stringent rules about centralized exchanges. I have no problem with that at all. The problem I have is with the misdirection of the conversation by saying this is a decentralized thing that works with absolute mathematics and certainty, and this is a thing run by humans. The humans thing went all wrong. Let's regulate this thing which is coded with certainty. It makes no sense, and we have to sort of see that when we read it.
Right. Joshua, really appreciate you taking time and being part of the podcast. My last question to you, what's your view on India's market? Because, the blockchain, the metaverse, the Web3 industry is completely rising. And somebody who's been at the forefront, with Bitcoin, what do you think is going to be the future of, the finance, the monetary system?
What I love about the Indian market in general and the Indian zeitgeist is that it's always had this mix of anarchic free market flow to it. So you go into Delhi, there's people selling you stuff. There's lots of trade, and there's this definite flow of freedom. When it comes to cryptocurrencies, I think there is a long way to go for people to understand what scams look like. And this is the biggest thing. And this is why podcasters and educators are really important in India, to show new people coming in what a scam looks like. And it's also important to reserve the word scam to actual scams, because it's a powerful word. A lot of the time, a lot of Bitcoiners have called everything a scam that's not Bitcoin. And this is dangerous, because people then see Ethereum, he called Ethereum a scam, and something like OneCoin comes along, which was an absolute Ponzi scheme. They also call that a scam, so now everything's a scam. And this is not true. And so educating the market is really important. But the future for India is super bright. I see India as the next major global power to rise. We saw the rise of China, and now I think it's really, really important that India embraces competition within the currency space, because this will make the population more powerful. This will empower the individuals. It will bring value to individuals to allow them to build a better space. It will also bring a lot of global trade in, because now you have an instant settlement layers within India. it's just a matter of education and making sure that people don't get scammed by very clever AI that is backed by people or just people in general. So yeah, the future cannot be brighter for India. I see actually the future is kind of dull for a lot of places in the world, but I see India as this rising star right now, especially when it comes to digital currencies, the metaverse. All of this stuff is huge, and I think if I had to put my money anywhere in terms of a bet of a geographical region that will succeed in the next decade, it's definitely India.
Thank you, Joshua. Really appreciate you taking time and being part of the podcast. Yes, I think there's some really cool things happening here in India. And talking about FTX, I mean, the world's talking about the 9 billion, 16 billion scam or whatever. But we point out to the Web3 world, but there is so much actual scams in the traditional banking finance industry. There's this FinCEN files, which talks about how the banks have been moving dirty money, transactions involving money laundering, terrorism, drug dealing, and just the data between 2000 to 2017, there was suspicious transaction of around $2.9 trillion. So there are wrongs with the traditional banking industry also. So yes, I think with the Web3, the cryptocurrency, I think we're building the future of the finance. So I think it's new, and I think we need to give it time for it to mature and become something that will be really beneficial for everyone, rather than just pulling it down. So thank you. Really appreciate you taking time and being part of the podcast. And to my listeners, if you like what you see in here, then please press the subscribe button. Until next time, see you guys. Bye bye. Thank you, Josh. Really appreciate this.
Thank you.